Welcome back to Everything Financial Radio. I'm your host, Dennis Tubbergen. I have the pleasure today of chatting with Dr. A. Gary Shilling, president of A. Gary Shilling and Company. And Dr. Shilling, if someone wanted to learn more about your work, what would you advise them to do?
Well, they can. We do have a monthly newsletter, and we have a toll-free number that you can call if you want more information on that. The number is 1-888-346-7444. 888-346-7444. And also, as you mentioned, my latest book, The Age of Deleveraging, is still selling well, and it's available, and that'll give you a long-term view of how I see the world.
Well, I would certainly encourage the listeners to do that, and I might add that yours is one of a handful of newsletters that I pick up and read as soon as I receive it every month, so I'd advise the listeners to take a look at it. I'd like to go back and revisit, if we could. You mentioned demographics, and we also talked about deleveraging, so if I can attempt to paraphrase here, we have a swelling population at the baby boomer age. We've got debt that needs to really be purged from the system. So we've really got two pretty strong headwinds that are affecting economic growth. When do you see this tide turning?
I think it's going to be a few more years. Now, the demographics are not quite as bad as you might think. The post-war babies are aging, but we have the advantage in this country, even though the birth rates are low. And last year, it was just reported by the Census Bureau that among whites there were more people died than were born. But we do have immigration, legal and illegal, and that's very important because that's what keeps the economy growing. It keeps younger people coming in who tend to be more innovative, and obviously they're more likely to have jobs than older people. So we're not really in as bad shape as you might think in terms of the demographics. Now, in terms of deleveraging, this normally is about a 10-year process. In other words, working down the excess borrowing that took place among financial institutions, banks, consumers, when people went from 20% down on a house to 10 to 5 to 0, as we had back in the housing bubble. After you have the collapse that followed, it takes about 10 years to get the working off that excess debt. We're 5 years into it, and if history's any guide, we got another 5 years. So I think that it'll be another 5 years, give or take, before we see the resumption of growth. And I think we will see a return to normal growth. Right now, we're growing 2% in terms of inflation-adjusted GDP per year. We'll probably get back to the more normal area of around 3.5%.
Now, you mentioned housing, Gary. Let's talk briefly about housing. If you look at the news stories and look at what's going on in some housing markets around the country, you would maybe come away with the impression that the housing market is booming again with double-digit price increases year over year in some markets. Is this real recovery, or is this just another bubble created by Fed policies?
Well, some of it is, of course, a bounce off of a bottom. House prices declined nationwide by a third, and in some of these areas where you've seen the big rebound, say Phoenix, for example, prices were down 60 or 70%. So, you know, if you're down that much, even if they double, you're still down. So some of that's what's going on. The other thing that's going on is that we're seeing an immense interest in rental housing. Multifamily housing construction has gone back to its earlier levels. Single family has not. And you also have a number of individuals and financial institutions that are buying foreclosed single-family houses and turning them into rentals. Rental demand is where the action is because a lot of people don't want to buy a house. They now know that for the first time since the 30s that house prices can and did fall. They can't meet the stricter lending standards. They're worried about having a job and so on and so forth. The problem with this is that the rental market is not the foundation of a strong housing market. It takes new homeowners, people who come in and buy the starter houses, so that those who sell them can move up to the next tier and on up the pyramid. And you've had very little activity of these first-time home buyers. So I think that the housing market is still pretty fragile.
I'd like to talk a bit about currencies, Gary, because there's a number of folks that I talk to that write into the program, and they're concerned about the future value of the U.S. dollar. And when you take a look at China and Australia putting together a direct trade agreement, China now talking to New Zealand about a similar agreement in order to bypass the dollar. What is your take on the future of the U.S. dollar as the world reserve currency?
I think, as a matter of fact, I cover that extensively in this book, The Age of Deleveraging, and I believe that the dollar is going to continue to be the world's currency. Now, it doesn't say that there aren't other things going on, and you mentioned what's going on, in particularly in Asia, in some of these trade agreements where they are trying to bypass the dollar. Because in the past, if China was trading with Japan, they would do it in dollars. They'd have to convert yen to dollars and dollars to yuan, or vice versa. So there is some of that going on. But, to have a strong currency, we've looked at this going back to actually Roman times. You need open markets, free markets. The Chinese don't have that, obviously. They control their currency. You need a broad economy, which we obviously have, a big economy. You need one that is growing, that has productivity improvement, which we have. There are a lot of these basic characteristics of the world's currencies. You go back to the Byzantine. It was called the soldalis, and you go on to other currencies throughout time. In Roman times, the Phoenicians and so on and so forth. The Venetians, and what you find these characteristics, and I think that the dollar is probably going to remain the global currency for a number of years. There were a number of people that thought, for example, when the euro was launched in 1999, that it was going to take over. Well, we've seen all the problems there, so that's obviously not a rival anytime soon.
Let's talk about Europe, because Europe is definitely in recession. I believe, if memory is correct, that the European economy as a whole has contracted now for 6 consecutive quarters. How will this economic pain, Gary, in your view, affect the Eurozone? Does the euro hold together in its current form, in your view?
The problem with the euro is that they combine the Teutonic North with the Club Med South under one currency, but no common fiscal policy, and probably none is possible given the tremendous diversion of those cultures. Anywhere from from, as I say, the Mediterranean kind of style up to the very strict Teutonic Germans. But there's a tremendous effort to keep the euro together, because if you look back at how did this whole thing evolve after World War II, the French and the Germans got together, and they basically said, and this is pretty much literally what they said. They said, we got to find another way of communicating than the way we've done it for the last few centuries, which is all-out war. And they argued that if they could get their economies more intertwined, then the odds of conflict would be greatly reduced. And that's really what has ultimately morphed into the Eurozone, that French and German decision to really make it work. And there is that strong feeling. Now, of course, you get situations where, like Cyprus, and that was a cliffhanger a couple of months ago as to whether they were going to stick around. They did, and now Greece is just a perennial basket case. But there is a real strong desire to keep things together. But that doesn't mean that this thing is going to somehow straighten out and fly right, because to have these cultures converge to the point that you could have a common fiscal policy. In other words, that you could have a common determination of government spending and taxes and so on and so forth. Boy, you're talking about cultures that have been different for centuries and centuries, millennia. And it's very different in the U.S. I mean, we're basically one economy, one culture, and we were very lucky in that this country was largely developed after the advent of the railroad, which meant you could move people and goods and so on easily, and it made it very similar in different places. And the other thing was, of course, Lincoln's decision to keep the Union together at all costs, the Civil War being the price. But that has given us one huge economy. And in Europe, we go as tourists, and it's fun because you go from one place to another, 50 miles down the road, a different culture as tourists. It's wonderful. But from having a common economy, it's just hell. And I don't think there's any long-term solution but they're really trying to basically have enough coordination there that they don't end up fighting each other, which has been what they've done in the past.
Let's talk about Japan briefly. Japan's central bank has been printing money at what I would describe as a maniacal pace. How does this policy eventually affect Japan and the rest of the world?
Well, Japan is trying to get out of this deflationary funk they've been in for 20 years, and their route now is basically to trash the yen, to drive the yen down, and that will make their exporters much more competitive. And Japan is very much an export-driven economy. You look at the year-over-year growth in Japanese exports and the year-over-year growth in Japanese GDP. You know, you've seen one, you've seen both of them. This plan by Prime Minister Abe is being pursued very, very actively. Will it work? Well, Japan has to do a lot of restructuring besides this. They've got to change their whole political system. They've got to make their voting more equal, and rural areas now have much more power in the Diet, the legislature, than people in cities and so on. And they've got to make it a lot easier to bring women into the labor force and to fire people, and so they have lifetime employment in effect. They've got to make a lot of structural changes, but also Japan is facing the prospects of retaliation against their competitive devaluation. Now, that has been blessed by the G7 group of countries and the broader G20 group, but the point is that in Asia, these countries are competing for a fairly slow-growing pool of exports. In other words, you don't have Europe and the U.S. Demanding Asian exports the way they did in the past, and these countries are driven by exports. So you have this intense competition, and I think you've got to look for competitive devaluations following Japan. South Korea is the most logical candidate, and I wouldn't be a bit surprised to wake up one morning and find out that they have massively devalued their won in order to get even. You know, nobody in competitive devaluations ever initiates them. They're always just getting even. And that's what the Japanese did. They said the European Central Bank and the Fed were flooding the world with money, and that pushed up the yen, so they're just getting even. It's like the mafia. You know, the mafia, don't get mad, just get even.
Great analogy. Last question, Gary. What are you advising your clients to do with their wealth, given everything we've talked about?
Well, what we're advising and what we do in running our own portfolios is really moving toward what I call the risk-off trade. In other words, I think we earlier had the risk-on, which prominently featured being long stocks, being long junk bonds, emerging market debt, these things where people were exercising the zeal for yield and paying attention to nothing except what the central banks are doing. But I think now that is shifting, and where we are invested in our portfolios and suggesting this to our clients is what I call a quartet, and it's long treasuries and long the dollar. Those are the safe havens, and it's being basically avoid or be short stocks and commodities. And commodities have been falling. The dollar's been strengthening. The treasury yields have been all over the lot, and that has been happening while stocks were strong. So the risk on trade was a very odd one. It wasn't what you would expect, but I think we're moving to the opposite, the risk off. As I say, that's the quartet: long treasuries, long the dollar, and then short commodities and short stocks.
Well, the book is The Age of Deleveraging, and our guest today has been Dr. A. Gary Shilling. And thank you for joining us, Gary. We hope you'll come back.
I sure hope to. Thank you.
Everything Financial Radio will return after these words. Stay with us.